Welcome back, guys. Before we start, let's take a short trip down memory lane. In high school, most of us are introduced to Greek mythology. Zeus is the ruler of Olympus, he controls the sky. Poseidon is the god of sea, and Hades, who rules the underworld. For options, we have a few Greeks that oversee certain domains, from price to time and implied volatility. Greeks are important in options trading. They tell you how change in certain areas can impact an options premium. First one is delta. It is one of the more important Greeks for options. Delta's domain is price. It tells you how much the option price changes when the underlying changes by $1. That means an option with delta of 0.5 will be expected to increase by 50 cents if the underlying goes up by $1. Delta could also be interpreted as the probability of options expiring in the money. For an option with delta of 0.8, that means there is 80% chance of the options expiring in the money. The higher the delta, the better chance that the option will expire in the money. Gamma is delta's partner in price domain. Gamma tells you delta's rate of change. For an options with delta of 0.5 and gamma of 0.05, the option is expected to change by 0.5 for the first dollar move. And for the next dollar move, simply add the delta and gamma to get the new delta, 0.55. This also means that delta doesn't have a constant rate of change. You can think of gamma as delta's acceleration. Theta is the Greek of time decay. Theta tells you how much value the option loses with each passing day. If the theta is negative 0.05, the option will be expected to lose 5 cents every day. Time decay is the option seller's friend and buyer's enemy. Vega's domain is implied volatility. Vega tells you how much the premium may change with each 1% change in implied volatility. An option with Vega of 0.05 and implied volatility decreases by 1%, the premium is expected to decrease by 5 cents. There are a lot of factors that can cause a spike in IV, implied volatility, such as ER announcements, political situations, and even natural phenomena. Depending on your strategy, a spike in Vega could be a blessing or a curse. The farther your expiration, the higher your Vega. So, options with longer expiration may react more to changes in volatility. Rho is like the small god for options. It tells you how much the premium may change if interest rates change. Since interest rate changes slowly, Rho has a smaller impact on options premium. Let's take a look at an example. We have stock XYZ at $15. The premium is $1.5. Delta is 0.5. Gamma 0.05. Theta negative 0.02. Vega 0.08. Now, let's gather all the Greek gods and take a look at a quick example. You have an option with the following Greeks. The underlying goes up by $1 to 16 today. Your option premium increases to $2 because of delta. If you keep this option to tomorrow, your premium will lose 2 cents due to theta. At this point, your option is $1.98. The stock goes up by another $1 to 17 tomorrow. By then, your premium will be your new premium from today, $1.98, plus the new delta of 0.55, which will be 2.53. If the IV goes up by 1%, then your premium will be 2.61. And finally, you decide to hold your contract until the day after tomorrow, your premium will drop by 0.02 to 2.59 due to time decay. We will go over more about options in our next lesson, so be sure to subscribe so you don't miss it.